report. And joining us now is Ty Young of Ty J. Young Wealth Management. Ty, what are you watching more closely than anything else?
Well, Dagen, we're watching the market. It's volatile here, and these numbers coming in, we're watching those very closely as well. But really, the market being whipsawed like it has over the last several weeks, we're looking at the fundamentals of the market. We haven't had sustained growth from an economic standpoint, and what we've seen over the last several years is the stock market decoupling from Main Street, and the volatility of the market. We believe is the market coming back to meet the growth rate of the economy.
Well, I thought 3.7% Anastasia was pretty doggone good for the second quarter. I know it's backward looking, but you got lower mortgage rates, lower gas prices, and an economy here that's on solid footing. I think Main Street looks okay.
Yeah, I would kind of disagree a little bit with Ty there, because I think the market last week overshot and overlooked the otherwise strong fundamentals in the U.S. economy. I will give you that we're not growing at the pace that we've seen, prior to this recession. We're not shooting the lights out, but we're not certainly we're not on weak footing. You write about the GDP report, about the housing starts, about the new home sales, and also capital goods orders. All of those things came in above expectations last week. So I think we're in a pretty good place from the U.S. economic perspective.
Morgan, you're connected to voters, Main Street, how they feel. How do they feel? Clearly, there's something politically going on in terms of how people have gravitated to these very populist candidates. But in terms of how people feel about their financial situation, it seems to be okay at this point.
When you look at the world economy, when you look at China and the emerging markets, clearly the U.S. is still leading and on the forefront. But saying that, I don't know that the average person, that's sitting in Topeka sort of understands, what the Chinese consumer is going through, what's happening in Europe, and they know that they're not satisfied with the rate of growth that the U.S. has experienced over the last 6 years under this president. So I agree with you. I'm not surprised at all that people are looking to these populist candidates, because this has been said often on the show, and you said it several times, people are sick as business as usual.
Right. Ty, you sound, negative on the U.S., but you still have to give your customers ideas about where to put their money. So what are you looking at? What are you positive on?
Well, I'm positive on America, and I'm positive on our markets long term. And what I was referring to a moment ago is the macro of the market. Over the last 6 years, we've had anemic growth of the economy. About 1%, with 1 year there was 4% growth, and 1 year we actually had a contraction. Relative to the meteoric rise of the market, if the market comes back and meets the economy, we've got some downside again from a macro level. Those reports that were mentioned just a moment ago, that's positive news, and we have to weigh that. But looking at the fundamentals of the market, looking at what's going on in China, and they're obviously struggling, and looking at the Federal Reserve, are they going to raise interest rates? We don't think that they are. We think it's more likely that we get QE in 2016 than a rate hike in 2015. So when people come to us, when people come to my firm, we're different. What we do is different. They want their money protected against losses. They want to make as much as they can, but they want to make sure they don't go backwards. Structured products is what we're using more than anything else right now, where they have the protection on the downside, and they don't get all the upside of the market, but they do get a portion of it, and the gains lock in on an ongoing basis.
Anastasia.
Yeah, I agree with the point that I guess, the U.S. economic growth could have been better, right? But the reason why the stock market has surged as much as it did up until this year is because earnings of the U.S. corporations have staged this V-shaped recovery since 2009, and therefore the stock market has rallied as well. But part of the reason, Dagen, why the stock market underperformed so far this year is because we have not actually had earnings growth this year. And I think that's a bit of a headwind, I would agree, going forward, is because lower oil prices, stronger dollar is actually not a great combination for the stock market in general, but you absolutely can find places within the stock market that benefit from it.
Financials, if the Fed starts raising rates.
Right, if the Fed starts raising rates, but also if you assume that the curve actually steepens. Right. And I think that's not a given. Because what you also have is, if I look at a 2.2% 10-year Treasury yield, and if I compare that to the rest of the developed market 10-year notes, that is a high yield. 2.2% is a high yield, believe it, right? So if that's the case, then a lot of foreign money may actually be pouring into U.S. Treasuries
and putting pressure down.
And putting downward pressure on that yield. So it's not a given that when the Fed hikes rates that you actually have this massively steeper curve.
Thank you, Anastasia. Ty, thank you for joining us. Ty Young for us.
Thank you.